All right, it's time now for Wall Street Week. And the host of Wall Street Week, David Westin, he spoke with Federal Reserve Bank of San Francisco President Mary Daly yesterday about whether the Fed takes into account interest paid on common expenses such as auto loans and credit card bills. Take a listen.
The way monetary policy works is actually you raise the interest rate, and that raises borrowing costs, and that slows people's spending, and then the economy settles down to a more sustainable pace and inflation comes down. That's how the models work. That's how it empirically works over time. What's different this time is that consumers have just stayed in the game. They continue to spend. They continue to want to participate in the economy, and that's spurred growth, ongoing growth, and that's kept inflation a little bit higher for longer than we would have thought. But I still think overall the news is good. And yes, we absolutely see the challenges that families face when they have to pay higher borrowing costs. But we also know that what they really want us to do is bring inflation down. There is no place I go. I have a very big district, 9 states, but you can travel anywhere in the United States, hear the same thing. What's your number one problem? Inflation.
There is a perception on some people's part that maybe the Fed was a little slow in getting started on the rate hikes, so you could have moved a little earlier. How do you avoid that problem on the way down, being slow on the way down? You said you don't want to hold all the way down to 2% and run the risk of a recession, but how do you know that you're on time with the cutting?
Well, I am deeply focused on that very question because I do think we were a little slow to adjust rates when inflation was gaining strength. But at this point, we have policy in a good place. We can adjust the policy rate down if the economy calls for it. But when you're still adding jobs at 1 to 2 times the rate that you need to keep the unemployment rate stable, when consumer spending continues to be very solid and often more robust than anybody would expect, and GDP growth is coming in so strong, there is no imminent risk to the economy faltering. So we want to make sure we calibrate. So we're balancing 2 objectives. If we let go of the reins on the economy too quickly, inflation gets stuck. And that actually takes that scarring effect we just talked about for people, and they have it for the rest of the decade or 5 years, or it gets into inflation expectations. All those things that we don't want to happen. Plus, it's a very painful tax on those who can least afford to bear it. The other option, though, is we hold on too long, and then the economy tips over, which obviously it hasn't done yet, but we want to avoid that. So that is a delicate balancing act, and it's why you keep hearing me and others say we're data dependent, we're not data point dependent, we're looking at the full complement, and we are agile, and we're sitting in what I call the ready position. We are ready to make moves and adjust as the data demand us to do. And I think right now the economy and policy are in a good place to do that.
One of the things a lot of economists say is an overarching notion of how much to hold the reins in or let them go is where the neutral rate is.
Yes, exactly.
And whether the neutral rate is where it's been or whether it's actually going up. There are some who suggest a variety of factors. The need geopolitics, the need to spend more on defense, deglobalization, less globalization. Various factors are really raising the neutral rate. How do you assess the neutral rate, and how does it factor into your decision making? So
the neutral rate is an estimated variable. No one really knows what it is. There's no truth with a capital T. But I do think that we have to be mindful that we came in with a neutral rate that was roughly 0.5, the real neutral. So we mean the nominal neutral is 2.5, 2% inflation plus 0.5. So I have in my own head that it's between 0.5 and 1. And that gives you a lot of room to say, yes, those factors you just mentioned could be pushing it up, but we frankly don't know. And so what we do know, though, is that whether it's 0.5 or 1, policy is still tight, and we're still having an impact on the economy that is the one that we would expect. We tighten policy and the economy slows through the borrowing costs rising and the things we already discussed. But so I think 0.5 and 1 is a reasonable span, and if you do that, then we have the answer we need, which is policy is tight, and then we can learn experientially whether it's 0.5 or 1, because we won't know in real time. When you say policy's tight, to what extent does the real interest rate figure into that? Is that how you monitor it? You basically take a look at the real interest rate and see where it is? Yeah, so it's a simple back of the envelope calculation, and by back of the envelope, I don't mean that's how we do our work. We do things on the backs of envelopes. But I think, seriously, these are very imprecisely measured variables. And so you can't rely on them and say, oh, the model says it, so that's how I'll calibrate policy. You have to look around in the economy and be data dependent. But how I would simply do it is if the policy rate's 5.25 to 5.5, and the nominal neutral is, say, 3, then that's a lot of tightening in the system. And so we still have a tight policy stance. So that's what I mean by 2.5 and 3 is not that different in terms of nominal neutral when you have a policy rate that's above 5.